What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guest in this week's episode is Jared Dillian. Jared is the editor of the Daily Dirtnap. It's a newsletter for professional investors focused on gauging and capitalizing on changes in market sentiment. He's also the author of two very successful books on Wall Street and investing, and is the host of the Be Smart podcast, where he talks to his listeners about everything from how to sort out their personal finances to how to approach trading and investing in the stock market and everything in between. This conversation is yet another in a series of episodes that I've been doing focused on how to navigate the transition in market regimes that we're currently living through and all of the challenges that this transition presents for our assumptions about markets and the world at large. I asked Jared to come on the podcast today not just because of his focus on sentiment, but because he really is someone who stands apart. He's a contrarian in the purest sense of that word. And during a time when many of the people I follow and speak to on and off the air increasingly seem to share many of the same perspectives on the future path of interest rates, inflation, and energy prices, bringing on someone like Jared is a way of holding myself and my ideas accountable. And that's incredibly important to do, especially when it comes to money and investing. But Jared also has another unique quality, which is that he publishes an investment newsletter, which means that he spends an enormous amount of time thinking through his investment ideas and stating his opinions in public. And that can be very tricky to do while also managing to invest successfully in those ideas, exactly because of how easy it is to become emotionally invested in being right. And this is something I've seen time and time again over many years of being in this business. Financial commentators and pundits will twist themselves into pretzels, trying to align their public statements, personas, and track records with an ever-changing set of market conditions. So one of the topics that Jared and I discussed today is how not to do that and how to know when someone else is doing it. In other words, how to filter through information so that you know who to listen to, what to take from them, and then how to exercise a level of humility in your own investment mindset so that you don't get caught off sides during a period of time where I think market conditions and assumptions about risk and allocation are going to be changing faster than at any point since the great financial crisis. As most of you already know, Hidden Forces is listener supported. I don't rely on advertisers or commercial sponsors. So the second part of today's episode with Jared is available to premium subscribers only. You can access that part of the conversation as well as the transcripts and intelligence reports to each episode by visiting our website at hiddenforces.io, selecting the episode that you're interested in, and clicking on the premium extras, where you can then sign up to one of our premium content tiers. Since some of this episode deals with investing, it should be absolutely clear that nothing we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guest are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this week's episode with my guest, the one and only Jared Dillian. Jared Dillian, welcome to Hidden Forces.
Hey, thanks for having me.
It's great having you on. You got a great setup, which makes me happy. You got a professional mic, and you got a really good branding there behind you, but no one can see that because we don't do video.
Yeah. The branding behind me is pretty new. I've had that for a couple of months. The problem is it blocks out the window. Like I get a lot less light in here. So
it's interesting. Be Smart podcast. The name of our newsletter is Get Smart.
Oh, Get Smart.
Yeah. Well, we kind of ripped it off a little bit from the 1960s TV show. So, Jared, it's great having you on the podcast. I hadn't discovered your work until recently because I've been on this kind of quest to solve some problems for myself in terms of allocation that I've talked about on the podcast. And one of the reasons that I wanted to have you on when I discovered your work is that you, in a world full of people who fancy themselves contrarians or think of themselves as contrarians, I think you kind of genuinely are. You do seem to be someone who marches to the beat of his own drum. And that was kind of the biggest reason I wanted to have you on. And then I started listening to your podcast and I really enjoyed it. And we'll get into kind of your style because I'm curious to ask you about that. But before we do any of that, what I would love is for you to tell me and our audience who you are. Like, how did you get into writing about finance? You've written a book on finance that has I think 150 reviews on Amazon. You've written a novel. You're an interesting guy. So what's your deal?
Well, I grew up in Connecticut, in southeastern Connecticut, which is kind of the poor part of the state, and didn't have money for college. So I got accepted to the Coast Guard Academy, which is, it's a U.S. service academy. And went there, served in the Coast Guard for 5 years afterwards. I got stationed on the West Coast, spent a couple of years at sea, doing mostly fisheries enforcement. Then I started working in the Pacific area office in Alameda, California. I was doing intelligence. While I was there, I got my MBA part-time from the University of San Francisco. I wanted to work on Wall Street. I got interested in finance during my first tour. There was a bookstore in town. I started reading a bunch of books on finance. The first book on finance I ever read was A Random Walk Down Wall Street, which I thought was the dumbest book that I ever read and wanted to prove that efficient market theory was wrong. So I got my business degree. I also got a job part-time on the P-Coast Options Exchange as a clerk, clerking for options traders. And that was my first exposure to the markets in 1999 and 2000. And if you think about the context, the dot-com bubble was going on. I was in San Francisco on the options exchange. It was one of the most crazy times. My memories of that are just incredible. My novel is actually about that period of time in San Francisco. So then I got hired at Lehman Brothers. I did index arbitrage for 3 years. Then I was asked to run the ETF trading desk. I did that from 2004 to 2008. I had a great Wall Street career. What can I say? Actually what happened is that when I was made head of the ETF desk in 2004, I was told by my boss to market the business. It wasn't really so much to make money trading. It was to market the business. And my idea was to write basically commentary on Bloomberg, send it out, and get a following. So I was sending out these Bloomberg commentary while I was at Lehman, and I got a huge following. I had several thousand people that were getting my Bloomberg messages, and our revenues in the business went up about 4x in 4 years. It just exploded in growth, and it was mostly because of this notoriety that I had gained from writing about markets.
Wow, so many threads to pull on here. So let's go to the very beginning, which was your time in the military. How would you say that experience shaped you, and how has it influenced your thinking as an investor, and does it influence your writing in any way?
Well, people in the military, but especially the sea services like the Navy and the Coast Guard, are very risk averse. So I'll give you an example. We would be off the coast of Washington State. There'd be some fishing boats around, and we're in law enforcement, so we're supposed to board the fishing boats. But if there was more than a 5 or 6 foot chop or a little bit of winds, the captain would say, nope, we're not going to board these fishing boats today because it's too dangerous. If somebody gets hurt, then we got to do a bunch of paperwork and my career gets affected. So people really operate from this zero risk mentality. So when I started working on Wall Street, I was extremely risk averse. And the interesting thing was index arbitrage was the perfect job for me because basically I was just scalping. All day long. I was doing NASDAQ futures with the underlying stock. And it was a perfect job for somebody who was risk averse. But over time, I had to learn how to take risk.
You were exploiting inefficiencies.
Yeah, actually, I'll tell you a story from back then. So, this is really before things were electronic. I was trading stocks. I had a programmed trading terminal. And if you had a piece of economic data that came out during the day, like at 10 a.m., like ISM or something like that, I would wait with my finger on the button. And if the number came up extremely high or extremely low, I would send a basket of stock. And basically, I was just being fast. I made money by being fast. And of course, today, this is all done by computers. They have algorithms that are programmed to do this in microseconds. But I probably made $500,000 a year just by being fast on the button.
That's so interesting. Yet another job that's been replaced by machines. So let's go ahead and talk a little bit about your time in San Francisco, because that's also so interesting and I think so obviously relevant and applicable to today. And then I also want to hear about your time working as the head of the ETF desk and what you did during that period and what that taught you and how that's not just informed, but helped you as an investor. So let's start with San Francisco, because that just relates so much to kind of where we are today, the dot-com bubble, the euphoria. So much of that is what we've been experiencing recently. What was that like, and how has that informed your writing and your investing?
Well, the funny thing is that, you mentioned at the beginning that I was like an actual contrarian. I really am wired this way. So, I didn't know a lot about stocks or finance or anything, but I'm in San Francisco. There's .com billboards everywhere. There's purple Yahoo taxi cabs that had internet access in them. Like the whole town was like .com. And people were making money all out of proportion to their intelligence or work ethic on the floor. Like you had these guys who were complete goons that were making hundreds of thousands of dollars a day. And I was sitting there, I was like, this is not sustainable. Like this is definitely not going to continue in the future. And, that exchange was hollowed out by, I would say, by about 2002 or 2003. I would say 90% of the people were gone, So I was there for just a short period of time.
Do you think what we've been living through recently, especially with all the stuff that's gone on in crypto, but also a lot of these tech stocks and meme stocks and stuff, is reminiscent of the dot-com period? How similar is it and how different is it?
It's more similar than you think. I mean, the crypto.com arena in, I guess, Los Angeles, like, FTX on umpires' uniforms, like it's really all the same stuff. I mean, you see it like in every cycle. I mean, the one thing I will say, specifically with regards to crypto is that, you're going to have waves of investment over time. And you have a period of euphoria, then you have a period of revulsion, then you have a period of neglect. And crypto will go through this period of neglect for 3, 4, 5 years, however long it takes. And then there will be another bull market. Like it'll happen. Like we'll get another wave of investment. If you think about the pattern that the dot-com bubble followed, it crashed basically in 2002, 2003. And then for 10 years, tech stocks basically did nothing. Throughout the 2000s, you had a bull market, but it was mostly value stocks, commodity stocks, stuff like that. Tech stocks were dead for 10 years. But what happened was you had Apple, Amazon, Facebook, Google, Netflix that went on to become $1 trillion market caps. And so I guess what I'm saying is that, within crypto, you have 2,000 to 3,000 individual blockchains. Most of them are going to disappear, but 10 years from now, there's going to be 4 or 5 of them that are really worthy of investment that are going to take off.
So is it even more of a bubble today, let's say specifically in crypto, because of the fact that so many of these assets, especially Bitcoin, which is the very first crypto asset, were by their nature financial assets to begin with, that they weren't companies that people were speculating on, but were actually seen as money or assets or something like that?
Well, I mean, with Bitcoin specifically, my theory on Bitcoin is that it's similar to gold, right? Think about this. 2,000 years ago, what did the financial system look like? It was just gold. That's all people had. There was no bank deposits. There was no lending. There was no stocks. There was no derivatives. All it was gold. And over the course of 2,000 years, as the financial system became more complex, you had fractional reserve lending. You had the first publicly traded companies. You had bonds. You had derivatives. And the financial system gets more complex over time. And gold plays a smaller and smaller role. Gold used to be 100% of our financial system, and now it's about 1%. Bitcoin will follow the same pattern, okay? There will be other assets, there will be other blockchains that will actually have a higher market cap in percentage terms than Bitcoin. So that's going to play out over time.
That's interesting. So that's actually something that we should probably talk about in the second part of our conversation, dig into it deeper. So just one last question. Tell me a little bit about your time at Lehman before we get into the rest of this conversation, because I'm curious what that experience taught you.
Well, it was an amazing place to work. It was fantastic. I mean, I didn't get along with everybody, but everybody was there to work hard and have fun, and people were very ambitious, and they worked their asses off. I mean, it was absolutely incredible place to work. And the thing about it was, it was a pretty big firm. It had about 15,000 employees, but there was no bullshit. There was no bureaucracy. Like absolutely none. If you wanted to get a new computer monitor, like you could just ask the IT guy and you would get one. There was no filling out forms. It was very flat. You could talk to anybody. It was just an incredible culture. So I really enjoyed my time there. And, that diaspora of, Lehman employees that went around Wall Street, like they're still spread around Wall Street doing good things.
So you weren't there during the crash in 2008.
I was, yeah.
Oh, you were? So you left with everybody else?
Yeah, so what happened is that, Barclays bought the broker-dealer, so basically the investment bank, for $2 billion out of bankruptcy. And, I was asked to stay on, and I left. I said, no, I don't want to. I had a whole bunch of reasons. I really wanted to do the newsletter. I really enjoyed writing more. I started the newsletter basically a month after I left Lehman. And yeah.
So would you describe yourself first as a trader or first as a writer?
Well, I was first a trader and now I'm a writer. But I'm a writer who trades. First, I was a trader who writes, and now I'm a writer who trades. So,
well, here's where I'm kind of going with this. I find it very difficult to have a strong opinion as a writer, which is what I feel like you need to gain a following, while also being a good investor. Have you found that to be true as well? How do you navigate that line between giving people what they want, which is what grows an audience in many cases? And we can talk about the difference between giving people what they want and what they need and the long game versus the short game. But those things versus the disposition and the lifestyle that one needs to have to be a really good investor.
No, I don't. I make it work. I don't think so at all. I mean, one of the things about being a financial writer is a lot of people believe that you're supposed to have an opinion and you can never change your opinion. You know what I mean? So in my newsletter, I change my mind all the time. I'm long something, I sell it, I turn around, I go it the other way. And like a lot of people are just stuck in their opinions, and they also have a difficult time saying that they were wrong. I say that I was wrong all the time. Like, I screwed this up, let's try it again. So it's really about like being intellectually flexible, I think.
Yeah, I love that. And actually, I have noticed that with you. And to that point, your writing style feels very stream of consciousness. And so does your podcast, actually. You have most of your podcast episodes are very short. They're like 10 to 14 minutes or whatever. And it just sounds like you kind of literally just speaking out of your mouth. So would you say that in order to be a good investor while you're also writing a newsletter, you have to be brutally honest?
Yeah, I mean,
because that's extremely rare, and most people feel very uncomfortable doing that.
Yeah, I mean, I also, in the newsletter, I'm very open about a lot of things in my personal life. I talk about my struggles. I talk, mental health is a big thing for me. I'm bipolar. I was diagnosed bipolar in 2006. So one of the things I do is I'm very radically transparent about my struggles with mental health and how I'm doing with that. So, yeah, I mean, I think that's one thing that people appreciate about the newsletter is the radical honesty. You know what I mean? I think a lot of newsletter writers or financial writers, they are always in a mode where they're trying to save face. Okay. They have a trade. It's not working. It's going against them and they're rationalizing it. And it's really about looking good and trying to save face, where what they don't realize is if you just admit I am wrong and you own it, then people's respect for you goes way up, right? And really my batting average is probably about 50-50, just like anybody else. The difference between me and any other person that's trading is that I am a good communicator and I can articulate things. And that's why I have a newsletter and people read it because they get guidance about what they should be doing.
So you actually hit on two things that I want to ask you about. One is, have you always had that type of humility? And what do you think accounts for? Is it something that you've actively cultivated? or is it something that comes naturally? And why does it? That's what I'd like to understand. And the second has to do with this thing that you just said about articulating, because I find this actually to be very helpful as a writer, as a thinker, as a public thinker, which is putting your thoughts out there somehow actually helps you formulate a more clear perspective on your own views, which actually makes you a much better investor because it helps you build conviction around your positions. You know why you hold a position, and you also know why you shouldn't hold it if you decide to change your mind, if events change. So take either one of those however you like. Maybe the first point about humility first.
I wouldn't say I always had this humility. I was a pretty cocky kid in high school, but I think I've been through a lot of trauma. Bad shit's happened to me. I had some tough times in the Coast Guard. I'm a 9/11 survivor. I was at the World Trade Center in 9/11. I had to deal with my mental health issues. Like, I've been through a lot of shit. And I think that really engenders humility. So, yeah, I like to say in the newsletter, I'm just another bozo on the bus. I'm just like everybody else. What was the other?
The other question had to do with being able to articulate your views. You said that makes you a very good newsletter writer and a writer in general. And I asked you, does it also make you a better investor?
Yeah, absolutely. So I've told people this. Let's pretend I won $500 million in the Powerball. Okay. So now I don't need to do the newsletter anymore. I don't need the income. So I'm just going to invest this $500 million. I would still write the newsletter. I would just send it out for free. I would still write the newsletter because it helps my process, right? Because what a lot of people don't realize about writing is you don't think and then write. You actually write and then think. You write, and as you're writing, you crystallize your ideas. Keep in mind, I write like 3 or 4 pages a day, every single day. And a lot of times when I show up to work, I don't know what I'm going to write about, but I just start writing some nonsense and then I start to think, and I think while I write. So, like I said, even if I didn't need the money for the newsletter, I would write it anyway because it really, really helps my thinking.
So I want to go back to this thing about changing your mind and what I asked you about in terms of having a strong opinion, because this is something that I have had to change in myself, like very consciously. I used to be very opinionated. I used to have strong opinions. I would state them. And in many ways, I think I was someone who felt like he needed to have an opinion about something, a strong opinion about something, if I was ever to focus on it in any way, that I couldn't just be open-minded. And I've actually cultivated the latter skill, approaching things with an open-minded perspective. And when I started the podcast, when I started Hidden Forces, that was one of the just core values that I instilled in myself in the way that I did the show. When I read your Twitter feed or when I listen to you talk on your podcast, sure, you might express views, but you're always it doesn't feel like you're putting a stake in the sand. It feels like you're kind of open-minded in your process. Am I wrong? And if I'm not wrong, how important is that?
No, that's right. And, I think in the financial world, you never really want to, look, whether you're a trader or a commentator, you don't want to bet your reputation. You don't want to put all your capital on one trade or one idea. You know what I mean? So it's really like managing a portfolio. Some ideas you have high conviction on. Some ideas you have low conviction on. You weight your portfolio accordingly. But, even the ideas that I have high conviction on, I'm not going to go on Twitter and say this is going to happen. And because, look, like, it's probabilistic. Like, anything can happen.
But also, do you feel, because this is what happens to me, when I say something like that, it messes with my process. It makes it so that I'm more likely to double down on a bad decision because I put it out there. And now I feel invested in it emotionally. My ego is attached to it.
Yeah.
So does it give you pause when you read other people's work where they do that? Does it make you think, ooh, I don't know if I want to. So tell me a little bit about that. How do you screen for that?
I don't want to tell on anybody, but.
No, I'm not asking for a specific person. I mean, generally speaking. And I think this is super important, right? Because when I was younger, I would look at guys that would make bold predictions and be like, those guys know what they're talking about, or at least they're putting their stuff out there. And people that sounded wishy-washy to me, I was like, man, that guy, I don't want to hear anything he has to say. And now I feel the exact opposite. Obviously, I don't necessarily see someone who's taking a more open-minded perspective as wishy-washy. I might have seen them as wishy-washy. That's a pejorative way to look at it. But I actually value that open-minded perspective, and I run for the hills when I see people making bold pronouncements and also moralizing. I think that's another tell for me. And there's a lot of that in the industry. And so I think it's important for people to try and have a framework in their heads, not just for how to approach investing, but also for how to approach information gathering and self-education. So talk to me a little bit about that. How do you filter through all of that noise?
I got a lot to say about this. So the very successful financial media people, whether they're conference speakers or writers or whatever, they all have one thing in common. They're very confident. Okay. If you go to a financial conference and somebody's speaking and they're very confident, it's very persuasive. If you're sitting in the audience, you're like, wow, this guy, it's not what he's saying. It's his tone. It's his body language. It's his confidence that is persuasive. And people like that get a very large following. You know, when I speak at a financial conference, which I do, I'm like, well, this could happen. That could happen. I don't fucking know. I don't know. That's the crazy part about it is we just don't know. We don't know anything. We can make our best guess, but we absolutely do not know. The other part that you talked about moralizing, this is a big thing of mine, is because people will have an investment idea, but then it turns into a right or wrong issue, a good or evil issue, right? People say, they'll say the Cathie Wood thing is classic because that's turned into a black and white right or wrong issue. She's bad. We're good. We're fighting for justice in the capital markets. You know, we have the suit and cape. You know, she's a scammer. She's a con artist. She's a bad person. Anytime I see that stuff, I just run the other way because if you're moralizing about a trade and you think you're on the right side, if you think you're the good guy, you're going to get slaughtered. Absolutely, it will happen.
That's really interesting because while I don't externalize a lot of my thoughts, I might share some of those, and there are cases where I have strong moral views on an issue, but I just try to keep them to myself because I worry that one, by talking about them, once again, we get to the same problem that we got in before, but also because I might be wrong. And not because I might be wrong and so that will bias me, but I might be wrong. And I just try to exercise much more humility in my life today, just given where I'm at and all the experience I've had, which is another weird thing, right? Which is, it's more excusable when you see that kind of behavior with people that are younger, because when we're younger, we kind of think we know everything. We haven't seen much. We're more likely to take strong moral positions. But I think one of the signs of maturity is as you get older, you've seen more things and you understand that there's just a lot of more gray area. Tell me why you're laughing.
I don't think people necessarily mature when they get older. No, I mean, there's no good or bad. There's no good or evil. It's making money or losing money. If you're an investor, that's what you care about, right? If you think I'm going to change the world, I'm going to make the world a better place, just shut up. It's making money or losing money. That's all it comes down to. So
how important is it to know your limitations or to be aware of your limitations in areas where you naturally lean in one direction or another? Let's say if you're a natural, for example, so I'm differentiating between, there are two questions here. One is just your limitations, but then the other question is also kind of like a way of talking about your biases, or Stanley Druckenmiller recently was interviewed and he talked about how he's talked about this many times, he's kind of got a bearish disposition. So he maybe will lean more into playing more minutes during a bear market than he would during a bull market. How important is that?
Gosh, it's funny because I would say, you mentioned Druckenmiller. I used to have a bearish disposition, and now I would say I actually have a bullish disposition. I think I've probably flip-flopped in the last couple of years.
Your life has gotten too good, Jared.
Limitations. Well, I do know that in terms of my contrarianism, sometimes it's reflexive, okay? And sometimes I'm just betting the other way just to bet the other way. and a lot of that's about ego. You know what I mean? Because it's fun if you're the only person who's right and everybody else is wrong. Right.
Well, that goes back to the whole thing about the newsletter and the dangers, because that's where it pays off and it's like you double down. If you're writing, then you really feel incentivized to differentiate from others and to make a big call because it puts you out there.
Yeah. I mean, I'm not really motivated by fame, I guess. I just want to get the call right. But I guess I think there's an aspect of my personality that, and I'm just telling on myself here, that, look, making money is the ultimate goal, but being right is also fun. And a lot of people crave approval. They want praise from people. They want to be told that they're smart, that they did something right. And I'm really no different. If my subscribers email me and said that was a really good call, thanks for that, that means a lot to me. So I'm motivated by that kind of approval. A lot of people are.
How important is it to take responsibility? So you mentioned early in our conversation that you try and hold yourself accountable for your mistakes. How important is that to being a good investor and to being a good trader?
It's important. I think the thing with me is, this is another aspect of my personality. I tend to dwell on my mistakes. If I make a bad trade, I'm upset about it for a month, Is that part of because I didn't know that you were bipolar. You mentioned it. Is that part of that? Is that part of the dynamics of being bipolar, that it makes it more easy to ruminate? I don't think so. I'm just really hard on myself. Really, you want to be like a professional athlete. You want to be a baseball player. You strike out, you want to have no memory of it. Your next at bat, you don't want to remember the last trade, basically. That's ideally what you should be like. And I strive to be like that, but I do dwell on my mistakes.
Why do you think you do that? Have you tried to change that behavior? I speak as someone that has a bias towards doing that, and I've worked hard over the course of my life to interrupt that process as much as possible because it's so destructive.
Yeah.
It's so counterproductive.
I mean, this is like trading psychology type stuff. This is the type of stuff that Denise Shull does, So, I would say that I am not the most emotionally fit investor there is. You know what I mean?
Sure.
I think I'm pretty good. I think, I've gotten a lot better over time. I think I was a disaster when I first started trading, but I'm not one of these people that's completely unemotional. They just, I don't know. Look, I'm a human being, that's really what it is.
Do you think that there are certain types of people that just shouldn't trade under any circumstances? And are there certain things that certain people just shouldn't trade?
I think 98% of people shouldn't trade.
How do you know if you're one of those people?
That's the problem. I would say 30% of people should just have a bank account and not even have index funds or mutual funds at all. Just literally just have cash in the bank.
But that's really bad advice today, isn't it?
Well, it was better advice a couple years ago, but today it's worse advice. But JP Morgan did a study. This was from 1999 to 2019. The stock market returned about 6% annually in that time period, and the average investor returned 1.9%, which was worse than bonds, worse than if they had just invested in bonds. And it's because of bad psychology. It's because of suboptimal timing. They get excited on the highs, they get demoralized on the lows, and they try to time the market. So I think 30% of people are just better off with cash in the bank. And everybody else, you just have to do this behavioral coaching where you say, okay, you have money in an index fund, you dollar cost average it, and you don't touch it. You never touch it. But yeah, I would say only 2% of people should be trading.
It's funny because you actually had a podcast, I think it was titled How Not to Be an Idiot with Your Money. What do you tell people? I mean, I can't imagine anyone actually emails you with that question, or at least not formulated that way. But what do you tell people? And again, this is not financial advice, But what does a normal person do, especially now, Jared? I mean, this is a huge problem, man. I mean, honestly, it was a problem even before we started having consumer price inflation, because the reality is that there are a lot of things that people want that have been going up in price. And this has been going on for a long time now with all this asset price appreciation. So that having your money in the bank just wasn't like a really great, appealing option. So what does a normal person do? Someone that, let's say, isn't really someone that should be trading and doesn't know the first thing about investing. And actually, just to like kind of put an additional accent on that, what does it even mean to know about investing?
Well, if you don't take an interest in money, then money is going to take an interest in you. Okay. It's sort of a twist on that saying about politics. So it's everybody's responsibility to educate themselves about money. And it's an individual responsibility. And there's lots of resources out there. You know, I'm working on my third book, which is about this, right? It's a personal finance book. Look, even in this environment where everything sucks, where stocks are down 23%, where bonds are down, 12%, like, you know, 2-year notes yield about 3.5%. 1-year bills are about 2.8%. Like, there's places where you can park cash and actually earn yield now, and you're behind inflation by about 4 or 5%, but it's kind of your best option in this environment. You know what I mean? So, like, there's still things that you can do. You know, my comment about how 30% of people should actually have cash in the bank, I actually think that's true even in this inflationary environment. I absolutely believe it's true, because sometimes the alternatives are just worse.
Well, actually, I would agree with that right now. I don't know if I would agree with that as a general rule over the course of the next 10 years, but I do think we're at a time where it's absolutely beneficial to be in cash, because there are a lot of opportunities that are coming our way. So to that point, I'm curious to understand what you think your edge is. What differentiates you as a writer? I mean, what do people come to you to get from your daily newsletter? And what do you think gives you an edge as an investor and as a trader?
It's sentiment. It's my analysis of sentiment. That's what I do best. You know, it's my belief. I mean, you have people like the CFAs, right? The CFAs do fundamental analysis. They pull apart balance sheets and income statements and do ratios, and they try to apply that knowledge to investing in stocks. Well, it doesn't always work. You know, just because you identified a mispriced security doesn't mean it's going to trade to where it's supposed to trade. Then you have the CMTs that do technical analysis. And, you know, I like technical analysis, but also it doesn't always work. But the one thing that always works in markets is sentiment, like analyzing human behavior. Because this environment that we operate in, you cannot quantify this, and it has resisted any attempts to quantify it over the last 100 years. It's an emotional discipline. It's about feelings. It's about how people feel about stocks. And the problem with this is that a lot of people say, well, it's voodoo, like trying to analyze sentiment is voodoo. It's all based on anecdotes and stories and stuff like that. Yes, it's absolutely true. Also, this shit works. You know, I mean, there were, you know, Tom Brady with laser eyes and the crypto.com arena, to bring that up again. Like, there's indicators like that all over the place, and it absolutely works.
It's so interesting. So let's delve into that a little bit, because you do take a qualitative approach to sentiment analysis. And I absolutely think that this can work, because I think human beings are very good at recognizing patterns. And this is how machine learning algorithms work and are able to derive meaning from huge buckets of data. But the problem is, how do you know if you're getting a representative data set? Like, I think about that all the time. You know, like, I spend a lot of time on Twitter and I get certain vibes from the people I follow. But how do I fundamentally know how representative that is of the investor mindset, and specifically of the mindset of those investors who influence stock prices or prices in general on the margin?
Well, you know, the way I do it is I put sentiment into 2 buckets, okay? And for lack of a better term, there's a smart bucket and a dumb bucket, okay? And what I should really say is not smart and dumb, but sophisticated and unsophisticated. That's a better word. So, you know, a lot of the people I follow on Twitter are sophisticated. Okay. And I like to gather those opinions. I also live in Myrtle Beach, South Carolina. There's a lot of unsophisticated people here who are not plugged into the markets. And I love to listen to what they have to say. It's astounding. If you want to know what's going on in the mortgage market, talk to a real estate appraiser in Myrtle Beach, South Carolina. Like, seriously.
What are they saying in Myrtle Beach?
Well, up until about 3 weeks ago, it was super, super hot. And they were worried that interest rates were going to continue to go up, and they did. And now it's kind of a disaster. So
we're recording this on Tuesday, June 14th. So let's talk a little bit about where we are today. Yesterday, we had a massive sell-off. And there are reasons to believe that the Federal Reserve may, in fact, add an additional 25 basis points to their rate hike this week. So from 50, expected to 75. And this comes on the news less than a week after we had a CPI print of, I think it was 8.6%. The sentiment out there is super bearish. Headlines, people doom posting on Twitter. Do you think we're kind of sketching out an interim bottom here? That question needs to be answered as part of maybe your larger perspective on where we are and what you're positioned for, because I would love to understand that, your perspective there.
Well, first of all, let me say, I think they're going to go 75. The Nick Timoraos Wall Street Journal article, that was leaked by the Fed. That was a planted article. So they're going to go 75. And I think the market's going to respond pretty positively to that. Because what that means symbolically is that the Fed is actually doing something about inflation rather than just this bullshit like, Chinese water torture, 50 basis point rate hikes. You know what I mean? So I think that's going to be viewed positively by the market. I also think that we are entering a recession as we speak. Okay. And I believe this, but could be false, but I believe that the 8.6% CPI print will be the highest. I believe the next print will be lower, and I believe inflation is coming down. Okay. I believe that for a bunch of reasons. One of my favorite economic stories of all time. Back during the financial crisis, when Lehman went bankrupt on September 15th, you have the BLS, which calculates CPI, but you also have online inflation measures. You have the Google Price Index, and you have the MIT Billion Prices Project. When Lehman went bankrupt, prices started to drop within hours. It happened that fast. So you're going to see a response in the real economy from this capital markets action, and you're going to see the rate of inflation go down over the course of the next month. And I believe that the next CPI print is going to be substantially lower. So if you think that CPI is coming down, like let's say you took that as an assumption, right? That you knew 100% chance that CPI is coming down, what would you do? You would buy stocks, you would buy bonds, you would buy gold, you would buy anything that's not nailed down. So that's my thesis. Okay, it could be wrong, but that's what I'm operating on right now.
So 2 questions, answer them how you like. One, what are you buying ahead of that? Are you waiting for the announcement? Are you buying ahead of it? I'm curious. And what are you buying, or what do you want to buy? And what are you using to determine that? And then the second question is, what areas of the economy do you think are going to be hit the hardest? And what does this mean for energy? Because man, oh man, has oil not been the most resilient thing in the face of markets collapsing and the dollar going higher and rates going higher?
Well, I'm not buying anything right now because I don't believe we've reached the point of maximum pain. I think we're close, but I don't think we've reached the point of maximum pain.
How do you know where that is? Might that be if the market sells off after a 75 basis point rate hike?
The problem is that I know we're close to it in terms of time. I think it'll happen in the next couple of weeks, but I don't know where it is in terms of distance. Like the market could crash, right? Like we could crash 10%. So I know we're close in terms of time. I just don't know where we are in terms of magnitude. So that's why I'm not buying anything yet. So, and plus the next print is a month away.
What do you use to make that determination?
I mean, there's some quantitative things. Like one interesting thing about this bear market is that volatility hasn't gone up at all. Like the VIX is basically in the same spot as it was at the highs, and equity volatility has not responded at all. You mentioned energy. I'm actually short energy a little bit. I'm short energy stocks. Just put this trade on a couple days ago. And like you said, it's so resilient. It's incredible. But, when I look at sentiment, you go on Twitter and there's this whole like posse of like energy guys that kind of run around, and they're the only guys making money over the last 4 months. They're the only people making money, and they're absolutely, overjoyed about this.
So you're right that they've been making money, and they have been, I think, ahead of the curve, some folks, on identifying that, and I think also explaining and giving compelling reasons on the supply side, the underinvestment of the supply side, on why that's the case. Mm-hmm. So the question is, I guess there are two questions again. One is, how valuable is it to really look to gauge sentiment based on Twitter and based on a narrow group of folks who have done very well in this trade and who maybe had the tools and the frameworks to correctly identify it? And then two, how do we really gauge what the underinvestment on the supply side means in the face of cratering demand? I mean, how do we kind of evaluate all of that? Maybe that's a fool's errand. For me, I think it is. And I have not added to my position in energy because I just find that to be too risky in this environment, because I can understand the demand side dynamics, and I have been explained the supply side dynamics, and I understand them better than most people as a result of that, but I don't understand them nearly enough to feel confident buying oil at $120 a barrel.
Yeah. So I think, look, I mean, the energy guys have gotten the supply side right. I mean, they've absolutely gotten it right with ESG and what the government's doing and stuff like that, for sure. There is demand elasticity in oil, for sure. Saw an interesting stat recently. AAA says that they've received a 31% increase in calls from people who have run out of gas on the road. Because
I saw that in your article. That's amazing. It reminded me of that. There's a back and forth between Shaq and the guys on the halftime report for the NBA, where Shaq talks about taking I don't know if you've seen this thing, but anyway, no. Tell your story, because I don't want to interrupt you.
Yeah. So what I'm saying is there is demand elasticity. So a lot of the energy guys are very dismissive of the demand destruction argument. You know what I mean? But if you go back to 2008, oil went from 140 to 30 in a couple of months, and that was all based on demand destruction.
100%. But the argument that you will get from people that spend their time analyzing the supply side will be effectively, but we didn't have the attack on supply in 2008 that we have in 2022. That's the argument, right? And so I guess let me ask you a practical question just to kind of reemphasize it. What does a guy like you do in a situation where, and I don't know, you have to tell me the extent to which you understand the supply side argument. What do you do if you don't know enough to really know if they're right or wrong? Do you basically try and judge the credibility of the messenger? How do you navigate a situation like that? You know what I mean?
No, it's not so much about the credibility of the messenger. The messengers are very credible. It's that the bull case is always most compelling on the highs, right? Like the argument for, we'll just use energy as an example, but it applies to everything. Like if you're in a trade, when the argument is the most compelling is always on the highs. That's when it seems the most bulletproof. You know what I mean? And then there's a change in prices come down, and sentiment changes with price. So for sure, I mean, you could have said the same thing with .com stocks in 2000. The argument was the most compelling on the highs.
Yeah, no, I mean, I totally get that. And not to beat a dead horse, there's so many factors that push me in either direction here. Because one, I worry that I'm in an echo chamber and that most people haven't caught up yet to this bullishness on energy. And it makes me, wonder, are we just getting going really here? And maybe it'll take a breather, but is that a meaningful breather? And am I just going to regret, let's say, not adding to my position at these levels? I
mean, let me put it this way. I'm not saying it's going to be the top of all time. It can be a top. Like if oil goes from 120 to 90 or 100, that's tradable for sure.
Absolutely.
You know?
Absolutely. And, speaking personally, that's kind of what I would be holding out for. So what about bonds? I know you've been bullish bonds now for quite a bit. Talk to me about what your thoughts are there. How are you positioned? And what is the opportunity you see in bonds, given that you think this latest CPI print is going to be the peak? And how much does the Fed continue to hike going forward, given that we've already seen a substantial tightening of market conditions in anticipation of further rate hikes?
Well, the interesting thing is that they don't have to hike anymore, but they will. Okay. They're going to continue to hike until unemployment deteriorates, right? Because basically the Fed is a political institution, right? And they're facing political pressure on inflation. They're getting pressure to do something about inflation. That will change if unemployment gets to 5.5 or 6%. Okay. Then there's going to be pressure for them to do something on unemployment. What you've seen with jobless claims over the last 4 weeks is that they're actually going up. And the thing about jobless claims is that this is not a series that's subject to revisions. This is just raw data, and it's trending higher. And in the news, just anecdotally, you see lots of, notices about layoffs and stuff like that. So I believe the Fed's going to continue to hike probably 3 or 4 more times until the employment picture starts to deteriorate, and then they start getting political pressure from the other direction.
All right. So, Jared, I'm going to move the rest of our conversation onto the premium feed. I want to continue our discussion about inflation and the effects of tightening credit conditions on the economy and asset prices and what that means for positioning. I also want to talk about gold, because I think that's an asset class that continues to underperform the expectations that many people who have been holding it have had. And, that kind of also speaks to the thing that I really want to discuss with you, which is the new market regime, because it does feel like we are going to be living through a world of stagflation. There are inflationary forces that are going to put upward pressure on prices. Those things are geopolitical, they are geoeconomic, globalization and deglobalization, the move from efficiency, a world where we're driving towards efficiencies, to one we're moving towards resiliency. And the rising interest rate environment is also deflationary, but at the same time, you have huge amounts of debt, and it's not clear how we're supposed to live in a rising interest rate environment with such high levels of debt. Does that mean that the governments are going to maybe really get creative on mixing fiscal with monetary policy? Maybe constraining monetary policy, but also engaging in fiscal spending in order to try and bridge the inequality gap. That's something that I've thought quite a bit about, and which has huge implications for positioning and where and how you decide to allocate to. But we're going to talk about all that on the premium feed, Jared. For anyone new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want to access the second part of today's conversation with Jared, as well as the episode transcripts and intelligence reports, head over to hiddenforces.io and check out our episode library. We can also become a premium subscriber today. Jared, stick around. We're going to move the second part of our conversation onto the premium feed. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to full episodes, transcripts, and intelligence reports, which include additional notes, resources, links, and other material that will help you get the most out of each and every episode, check out our premium subscription, available through the Hidden Forces website at hiddenforces.io. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.